Hello. Today is January 11th, 2021, and hopefully it's not too late to say Happy New Year to everyone, so Happy New Year. I'd like to take a little bit longer today and talk about what investments we could possibly have for 2020 and beyond. And with that in mind, as I always say, asset allocation is the most important decision an investor can make. So let's start with that. Assuming a client, an investor has a long-term time horizon, and by that I mean 10 plus years, and most of us are going to be investing for 30, 40, 50 years or more. We're going to live to our 90s, a lot of us. So a 10-year time horizon is essentially appropriate for most people, unless you're in your late 80s or 90s already. So I'd like to start with the most controversial one, cash. Do we hold cash in 2020 and beyond, and how much cash do we hold? Well, first of all, it depends obviously on a person's individual circumstances, how their income is doing, how their employment is doing, how their business is doing. And if those are in question, then the cash requirement would be much higher. But assuming that we put enough aside for emergency needs, then just purely from an investment perspective, at this point in time, despite equities being already at high levels for valuations, cash is probably not the best place to be. And main reason why I'm saying that is because interest rates are so low. Central banks around the world have engaged in massive quantitative easing, which is a fancy way of saying money printing, and buying back securities of all kinds to help stimulate the economy from a monetary perspective, which is what they can do. That has helped the economy tremendously, I think, so far this year and last year. But more importantly, as the virus, COVID, and the response to it by all the governments, including all the restrictions they imposed for health reasons, brought down the economy rather significantly, and the slowdown would have been inevitably worse had the central banks not intervened the way they did. So that's all good. Cash, I would say 5 to 10%. And for some people, perhaps as little as 0% if they're in a more secure situation. Next, continue on the same theme. A place that a lot of investors likely have a low exposure in their portfolios is commodities, especially food commodities. The last 10 years, the commodity prices have come down despite asset prices going up. Now perhaps is a time for commodities, especially food, to start going the other way. And that's even if the economic activity doesn't come back right away. So we could have a situation where the economy is stagnating, yet commodity prices are going up because of, again, the money printing. A good way to get exposure to food commodities may be the DBA ETF trading on the New York Stock Exchange. There's others. There's just one. And along the same lines, another good place to have money is precious metals like gold and silver, anywhere from 0% to 15%, depending obviously on investors' goals, investment goals, and risk tolerance level. Gold and precious metals are mostly able to keep up with inflation and not deliver excess returns above inflation, real returns. So in other words, they maintain their purchasing power. However, if we need excess returns, then gold would not be the place where we're going to get them from. But this should be good for capital preservation. The next place where, again, investors, a lot of retail investors especially, have very little exposure to, if any, would be absolute returns type strategies. And by that, I mean investments where you try to make money pretty much at all times without assuming as much of the business risks and the business cycle risk that you get from investing directly in equities and corporate bonds and things of that nature. And in order to get those type of strategies, you typically have to go in the hedge fund world. And another area that we actually particularly like at the moment is the private debt space, where private debt funds would lend money to private corporations or even individuals or developers through mortgages and things of that nature. These loans are held in the fund's books at book value, meaning they don't fluctuate in value unless there is an impairment, at which point you take a charge. And you typically, as an investor, sit back and collect the interest. And the interest, because the loans are to companies that typically are not able to get funding from the banks, they will be below, at a higher rate than commercial loans would be. So the loan interest rates charged could be 7 to 12%. In that range, depending on the risk level of the investment, and typically they will be collateral on the loans in terms of security, assets of the corporation, or receivables, or property, or a combination thereof. A good fund that we use for our clients is the NextEdge Private Debt Fund. Fund serve symbol NEC442, and as I said, there are many other ones that we use. An allocation to absolute returns, return strategies of 35 to 40% would be fairly good at this level for multiple reasons. One of which is the valuations for equities are a little bit high at the moment, so we'd like to keep our public equity allocation a little bit lower than your typical retail investor's portfolio. And now turning into equities, an allocation of maybe 50 to 55% would be good, and that could be made of 15% exposure to private equity. A good fund that we use there for private equity for Canadian investors is the Kensington Private Equity Fund, symbol KEN115, I believe. Private equity is owning shares of companies that are not traded on exchanges, so they're companies that are either early stage or more likely pre-IPO stage, that are held by strategic investors or founders, or the funds have taken private after they had been public when the valuation was reasonable, and they will come back into the public market in 5 to 7 years' time. And special situations, there's a number of venture capital, a number of ways you could get exposure to private equity. And the advantage of private equity is that you get typically slightly higher returns than through public equities, maybe 2% or maybe a little bit more, without the volatility that's associated with the public markets, as typically the valuations of the private companies are appraised and they don't change much from day to day or month to month. Last but not least, public equities. And for there, a good allocation would be around 35%, and using something like MSCI World Equity Index, and an ETF or a fund that tracks it, or the S&P 500, or both, on the passive side. And on the active side, perhaps with a slight tend to value, as value has tremendously underperformed growth over the last 5+ years. And perhaps after the economy restarts growing, perhaps in the summer of this year, 2021 or later, that's where the companies are going to do the best, as opposed to the more stable, high growth technology, pharmaceutical, and so on. Now, a good fund there for active management for Canadian investors is the Vanguard US Windsor Value Fund, symbol VIC 300. And there's others, but that's a very low cost active fund. And last but not least, some individual stocks. And we have some stock picks for January and pretty much for the whole year. This should be good for the whole year. The theme here is good businesses at good prices in the different sectors, and sectors and companies that are about to benefit from what's happening in the economy now and in the next few years and beyond. First one is a financial company, Alerus Financial Corp, symbol ALRS. Financial holding company, banking, mortgage banking, retirement plan administration, trust services, checking, debit cards, savings, etc., etc. Financials have not done well over the last year or so, but perhaps with the return of the economy, these sort of companies can do well, and this one is attractively priced. It's quite small, only 500 million market cap, and we think it could do well. Second one, a furniture company, Haverty Furniture Companies, Inc., symbol HVT. Real estate is also likely to benefit from the much reduced interest rates and from the quantitative easing, from the buying of mortgage-backed securities and treasuries and government bonds by central banks. And when you switch homes, you typically need furniture as well. So furniture companies should do well. And in addition to that, even if you don't buy a new house, even if you're staying at home but also working from home, perhaps it's time to get some new furniture if you want to look good on those Zoom calls. And last but not least, a home builder, again tying to the same theme, D.R. Horton. Again, we believe it's a good company, good valuation, and it should benefit from what's going to be happening over the next 12 months and beyond. Thank you very much. And if you have questions about how any of these recommendations fit with your investment portfolio, ask your financial advisor or talk to us. Happy New Year.